Thank you for joining us at XM.com for this weekly Outlook video. I'm Christina Marujos. Joining me today is Senior Investment Analyst Rafi Boyajian. We'll be having a look at the week ahead, and let's start by down under. The RBA and RBNZ are holding their policy meetings this week. The RBA is expected to hold rates steady, whereas the RBNZ is expected to cut rates. Now, what can we expect for the outlook for future cuts by the central banks, and how will it affect the Antibodians?
Well, you rightly said the RBA is expected to stay on hold this time around. We saw the RBA cutting rates back in June and July. So after two cuts, they'll probably want to see what the effect of those cuts will be on the economy. We did, of course, get tax cuts in Australia as well. So all of that could potentially start to improve the economy over the coming period. So the RBA will not be any rush to cut just yet, though markets are expecting at least one more cut before the end of the year. And given the weak global growth picture, it's quite likely that even if we do get a boost from the two cuts and the tax cuts, that there might still not be enough to boost inflation in Australia. So the RBA will probably be forced to cut again. As for the RBNZ, they've only cut once so far. That was back in May. They've been on hold since then. And this week we did see some worrying data. Business confidence hit a one-year low. The next big data in focus will be next Tuesday's employment report. We've seen some weakness in the labor market recently, and if you don't get enough of a rebound for the second quarter, that's likely to worry the RBNZ, and that could be that's the labor market has been one of the reasons why the RBNZ embarked on a rate cutting cycle. And even after next week's expected cut, they will likely signal that more cuts will potentially be needed, and markets are also anticipating the same. And of course, those expectations have been weighing on both the Australian and New Zealand dollars, particularly against the US dollar.
Now, it's going to be a rich week regarding growth data. Q2 figures are expected out of the UK and Japan amid a slowing global economy. Do you think these reports will reflect this?
We are expecting growth in both the UK and Japan to have slowed in the second quarter. UK growth in the first quarter got a temporary rebound from front-loading by companies ahead of that original Brexit date of March 29th. And we're likely to see a bit of a reversal of that in the second quarter. So growth could actually be as low as 0% in the second quarter, perhaps even a small negative contraction there as well, which would increase the risks of a recession in the UK, especially as we approach the new Brexit deadline of October 31st. Despite all that, though, we saw this week from the Bank of England that they're unlikely to take any action until they know what form Brexit will take. As for Japan, the economy did pretty well in the first quarter, but the trade tensions have been hurting exports. In the second quarter, we're expecting growth to have slowed to 0.1%. Despite even if you do get an even weaker number, the Bank of Japan will probably want to still wait a bit before it decides to take any action, given the limited ammunition that it's got.
Speaking of trade wars, let's move into China. Of course, the trade tensions with the U.S. escalated again, with President Trump announcing an additional 10% tariffs on all Chinese goods. Now, China is reporting trade data this week. Do you think the ongoing trade uncertainty will be reflected in these figures?
Well, we're likely to see exports declining on an annual basis once more in July. Although there's been a clear impact on China's trade position, it hasn't been quite that significant until now. Whether things stay that way, it's hard to say, because, of course, you mentioned those the new threat of tariffs by President Trump of up to 10% on all remaining imports from China. So that could potentially make things much more difficult for Chinese exporters. So the outlook for the moment isn't looking too good.
And finally, let's have a look at Canada. It's reporting employment data for July. Now, the latest reports out of the country have been rather strong, supporting, of course, the loonie against the US dollar. Do you think this report will be encouraging as well?
Data from Canada has been mostly positive, although the last jobs report for June was a bit on the weak side. If we don't see a rebound in jobs growth in July, we could perhaps see some speculation that the Bank of Canada could soon join its peers in cutting interest rates. For now, though, the Bank of Canada is expected to stay on hold given the mostly positive picture there, and that's likely to continue to provide support against the US dollar.
Rafi Boyajian, thank you for joining me today, and thank you for watching us at xm.com.